Good morning. It's Monday, September 11th, 2023, and I'm Jared Hall with Harvest Investment Strategies, and you're watching The Week Ahead, where every Monday we update our clients and network on what could be impacting financial markets during the week. I'm sorry it's been a couple of weeks since we were able to post a weekly market video. We had some business travel followed by the Labor Day holiday, but we hope everyone is enjoying the first few glimpses of fall, with the mornings and the evenings cooling off quite a bit, and the first two Razorback football wins. Go Hogs! In our last video, we were awaiting retail sales numbers from several of the largest retailers in the U.S., the emphasis being on the strength of the U.S. consumer, and it seems that the average consumer has still been strong in the midst of higher prices that we've all been experiencing. However, many are beginning to speculate that this strength is in part due to the increase in U.S. credit card debt as a whole, and that many consumers may be nearing the end of their sustainable spend, with credit card debt up 12% since the third quarter of 2022. The Fed is taking this data point, in addition to numerous others, under consideration in its decision process for where their target rate level should be held. Currently, the Fed funds target rate range is from 5.25 to 5.5%, and the odds of a September hike are essentially zero, meaning the market's pricing in a pause by Powell and the other Fed members. As we look throughout the remainder of 2023, the odds are less than 50% for another rate hike this year. This week, the market will digest the newest consumer pricing and producer pricing indices, so we will see if there's any change in the Fed rate odds early next week. After the longest hiking cycle in decades, perhaps we are seeing a long pause from the Fed now. Ironically enough, the market has not moved at all since the Fed began pausing, chopping around sideways and down for the month of August and the beginning of September so far. This price action follows our expectations for moderated returns, at least relative to the strong bull markets of the 2010s. Businesses are getting fit, meaning shoring up their spending, and they're motivated to turn profits in order to fund their future growth prospects, while the potential for new investment in those businesses is slowing. It is our opinion that the market may be stalling while earnings catch up to valuations, and we hope this happens smoothly in tandem with a soft economic landing. As we move near the fourth quarter of this year, expect to hear more news about the 2024 general election. Candidates from the GOP have already began their primary debates, and pressure is mounting on the current administration to answer for the poor approval ratings. While the economic and fiscal policies that are being tossed around can affect the business playing field, we'd issue our first reminder that the economy is much larger than one political seat. Thanks for watching this week's video and following along. We'd appreciate it if you'd give it a share on your social media.